Hi everyone, Courtney here, and today we are going to discuss Schedule 1, Schedule 2, and Schedule 3 banks because I see a question about this on every Canadian securities course exam. This question here asks, what type of Canadian bank tends to focus on providing corporate and investment banking? So first of all, a bank is a financial intermediary, which means that its primary focus is the transfer of capital from those who have it or suppliers of capital to those who need it or users of capital. Banks are divided into three major categories: Schedule 1 chartered banks, Schedule 2 banks, and Schedule 3 banks. Schedule 1 banks are Canadian owned or domestic banks. So even if they have foreign shareholders, as long as they're Canadian owned, they're considered domestic Schedule 1 chartered banks. There are currently more than 30 domestic Schedule 1 banks in operation in Canada, but 6 of them stand out in terms of asset size, and these are the ones that we all know. We've got the Canadian Imperial Bank of Commerce, or CIBC, the Bank of Montreal, or BMO, the Royal Bank of Canada, or RBC, Scotiabank, Toronto Dominion Bank, or TD, and finally, the National Bank of Canada. Now, Schedule 1 banks can be further subdivided into three subcategories, which are large banks, medium banks, and small banks. Large banks have $12 billion or more in assets, and it's important to note that for a large bank, the control of any single shareholder or group of shareholders is restricted to no more than 20%. In contrast, with a medium bank, which is one which has at least $2 billion in assets, but still under $12 billion in assets. And in this situation, a single shareholder, which would be an individual or company, can own up to 65% of the voting shares. So that's for a medium-sized bank. An individual shareholder, whether it's an individual or company, can own up to 65% of the voting shares in a medium-sized bank, as long as the remaining 35% of the shares are publicly traded. Now, finally, with a small bank, which is one which has less than $2 billion in assets, in that case, there's no restriction. A single shareholder can own as much as 100% of the voting shares for a small bank. Now, a couple of other important points to note about Schedule 1 banks is that they are covered under the Canada Deposit Insurance Corporation. So that means that if you have, say, $100,000 in an account, then they will cover up to a maximum of $100,000 in case of, knock on wood, insolvency on the part of the bank. And another thing to note is that Schedule 1 banks are regulated by the Bank Act. And one area of focus under the Bank Act is the inhibiting of sharing of customer information. And these barriers that inhibit sharing across the bank's various business units are known as firewalls. And finally, the last point to note about Schedule 1 banks is that the major source of income for them is lending funds at a higher interest rate than they're, of course, providing for or paying out. So obviously, in order to make a profit, they're earning more than they're spending. So that should make sense. All right, so the hard part is done. The Schedule 1 banks are Canadian owned, domestic. They are subdivided into large, medium, and small. You want to know the shareholders' rights for each of those sizes of banks. They're eligible for coverage under CDIC, and the Bank Act for them focuses a lot on firewalls, apparently, which inhibits the sharing of information between various business sectors. And finally, their major source of income is interest that they charge on loans. Now, let's move on to Schedule 2 banks. Schedule 2 banks are incorporated and operate in Canada as federally regulated foreign bank subsidiaries. So the major difference is that Schedule 2 banks are foreign banks, but they operate in Canada with many of the same rights or privileges as the Schedule 1 banks have. So it says that the deposits that these banks can accept may be eligible for coverage under CDIC. They may engage in all the types of business permitted to Schedule 1 banks as well. Another difference between Schedule 1 and Schedule 2 banks is that whereas for Schedule 1 banks, interest off of loans was the major source of income, with Schedule 2 banks, they derive most of their revenue from retail banking and electronic financial services. And examples of Schedule 2 banks in Canada include Amex, Citibank, and UBS. And all the banks of all these categories are regulated under the Bank Act. Finally, let's move on to Schedule 3 banks. Schedule 3 banks are federally regulated foreign bank branches of foreign institutions that have been authorized under the Bank Act to do business banking in Canada. Schedule 3 banks tend to focus on corporate and institutional finance. Examples of Schedule 3 banks might be Barclays Bank, Comerica Bank, the Bank of New York Mellon. So we've gone through Schedule 1, Schedule 2, and Schedule 3 banks, and remember these are categories under the Bank Act, which regulates all three groups in Canada. So with that in mind, let's go back and answer this question. Again, it asks which type of Canadian bank tends to focus on providing corporate and investment banking? Well, the one that's going to focus on corporate and investment banking is going to be Schedule 3 banks, because Schedule 3 banks that's where they're deriving most of their income, since they are authorized to conduct business banking in Canada. So I think the wording of this question was almost threw me off, because it said what type of Canadian bank, and I guess when I think of Schedule 2 and Schedule 3 banks, I think of foreign institutions that are authorized to work in Canada, but ultimately this is the answer they were looking for. So the key here would be to focus on the fact that they're looking for, do you know which bank focuses on corporate and investment banking in Canada? So Schedule 3 banks is the answer. But let's go through the rest. Schedule 1 banks, well, that would not be correct, because remember that Schedule 1 banks derive most of their income from interest on lending, and I don't even know what it's talking about when it says independent from investment dealers. Schedule 2 banks, well, they derive most of their income from, I think it said retail and electronic services, and so that also was not the correct answer. And then finally, Schedule 1 banks owned by investment dealers. I mean, we just know that it's wrong that they're Schedule 1 banks. I don't even know what it's talking about being owned or not owned by investment dealers anyway. So the correct answer is a Schedule 3 bank. I hope this helped understand the different categories of banks under the Bank Act and how they are differentiated from one another.